Good afternoon. It's Monday, the 26th of July, 2010, and we're going to take a look at the S&P 500 here, looking at the spiders. Here we're looking at a monthly chart. I don't only bring the monthly chart up, not because it's something I trade off of, but just to show you how far we've come this month. This month so far, we are up 8.08% on the SPY. However, year to date, today we had just turned positive. We're up 0.11%. So basically, we're at about break even for the year, up just slightly. Looking at the weekly time frame, we know that we had bounced from that 38.2% retracement level of the March lows from 2009 to the recent highs, and from there we're getting that's where we're getting this bounce. However, when we look at the weekly time frame, we're not fully out of the woods yet, because we can still see that we do have a pattern of lower highs and lower lows, and we're right at that 40-week or 200-day moving average, which is right here. We closed just a penny off of it. That moving average is at 111.57. We closed at 111.56. You don't want to use that as a timing tool necessarily. As you can see, we bounce back and forth above and below that, but instead we want to stay focused on some of the trends here. Now, in the daily time frame, what we see is we have now a pattern of higher highs and higher lows. We had broken that 110 level on Friday, and today we pushed out through there, added to those gains, and the more important higher low on the daily time frame is right down here at about 105.30. Now, the bears will tell you that we've rallied 2 days on lighter volume, and that's certainly a reason to take notice and look at this market and say, well, who's in control, the buyers or sellers? Well, on the daily time frame, again, we broke this downtrend line, we broke above the 50-day moving average, we have this higher low here, we have a higher high now, but it's coming on lighter volume. And we look at the 30-minute time frame, we are making a pattern of higher highs, and here's the 110 level. We have this pattern of higher highs and higher lows above a rising 5-day moving average. So from the intermediate term standpoint, we continue to give the benefit of the doubt to the buyers. We want to be mindful of support levels in the near term, such as about 110.70, and then this little area here at about 110.40, and then of course 110 is what we're going to be looking at, as far as that's where the breakout occurred. If we push back down through there, it will have trapped buyers. I think it will embolden some short sellers off that 200-day moving average and bring about some further profit taking as well. It's important to note that we do have a declining 50-day moving average, so I don't think that this push is going to be the one that gets us up through that 113 level and sustains, but we have to be prepared for it. Obviously, you don't want to close your mind to any potential scenario, and looking at some of the other groups, something to keep an eye on this week are certainly the financials, which have been trapped under this 200-day moving average. They're forming what looks like a nice little inverted head and shoulders pattern here. Breaking above that $15 level would maybe bring about some further strength in that group. And then the semiconductors have kind of a similar type of level at $29 a share. That's the neckline in resistance here at the inverted head and shoulders pattern for that group as well. And the semiconductors are leading market groups. So it's looking like, the buyers are where the market's shaping up here. The buyers have regained control recently, obviously, and as long as we can continue to maintain, I think, above 110 for this week, then we ought to continue to move higher to at least maybe some neutrality. But I think that the test of 113 does look reasonable. Be prepared for anything. That's what stops are for.